Soft Currency Economics by Warren Mosler. Further discussion of inelasticity. The Fed funds rate can be very volatile because the market for reserves is inelastic in the very short run. The banking system has no immediate way to rid itself of excess reserves. A system-wide excess of reserves would push the funds rate to zero. Even if banks were able to increase their volume of lending, excess reserves would persist. Within the current accounting period, each new loan creates a deposit somewhere in the banking system, but each new loan absorbs only a tiny fraction of the excess reserves. Furthermore, lending decisions are generally independent of reserve needs. With a system-wide shortage of reserves, the Fed is the only source of immediate funds. In the extreme, banks short of their reserve requirement fail if unable to acquire the required reserves. Faced with imminent failure, banks would bid up the funds rate trying to borrow from each other. As the funds rate rose, more banks would go to the discount window. Banks may try to reduce their reserve requirement by reducing the volume of their outstanding loans. However, forcing the repayment of loans is an ineffective method of meeting reserve requirements within the banking system. When a bank is deficient by, say, $10,000, a $10,000 loan may be called in to increase the amount of reserves by $10,000. However, the loan repayment lowers the deposits in another bank. The deficiency has merely shifted from one bank to another. Repayment of loans reduces the reserve requirement only marginally within the banking system. A huge reduction in the volume of outstanding loans brings about only a small reduction in the banking system's total reserve requirement. Reserve positions must be settled immediately, not months later. The banking system can obtain reserves on a day-to-day basis from only one source, the Fed. Within a given accounting period, the banking system has no other practical means of reducing its reserve requirement by a significant amount.